Okay, folks, welcome back. All right, so we're doing our weekly review, and again, this is going to be Monday's video. In other words, we're doing the analysis ahead of time today on Friday evening. It's a little late here locally. It's 10:30 my local time, but we'll try to grind through it. The dollar index, we're looking at the weekly chart here. We still are in this long consolidation relative to a weekly chart. Our buy side liquidity pool and sell side imbalance, buy side inefficiency is noted here. The dollar index is trading up inside of this last up close candle relative to the weekly chart. So it's expected to see some short-term resistance by itself, but we're looking to see if we can get into this buy side liquidity pool. Now, some of the things I'm going to say in the later portions of the video relative to other markets, because we're going to mention gold and we'll talk about euro and cable naturally, and we'll pop up into dollar CAD for a moment and the S&P 500. But all of those markets and the intermarket relationships, or intermarket analysis relationships that go along with the dollar index as it relates to that market or asset class, the dollar actually could stay in a consolidation. It doesn't have to drop and it doesn't have to rally. It can stay in consolidation, and the other markets can move in the direction I'm going to suggest they may in fact be going. It's a short-term condition. It doesn't usually stay in a elongated fashion. It's just very short-term. Generally, there's times where the market just simply creates a consolidation in the dollar index, and it allows the other currencies or asset markets to move in a specific manner and create a protractionary state, or more or less a Judas. So just put that in your notebook tonight, that when we're looking at markets and we refer to the dollar index, just like we can see a currency, for instance, like we would look at the euro pound. Now, euro pound, its dynamic movement, higher or lower, is going to be directly linked to one of those currencies being held in consolidation. So the dollar index itself is not immune to that. Just because we use it as a bellwether, we don't trade it. We look at it as a barometer, if you will, to help us determine the underlying pinnings of the market. Is it bullish? Is it bearish? Or what type of condition would we likely see? Even though we have a relatively bullish scenario still staring at us in this chart, I have to be aware of what the other markets that we're going to talk about tonight are showing. So it may cause some short-term consolidation or a little bit of bearishness in here. We have a little bit of support that would be seen with this two down close weekly candles. So if we see the dollar index want to trade lower, I'll be watching this candle here. It's high and it's open. Let's see if I can make it pop up here. Its open is 95.95 and its high is 96.35. So those levels are going to be, in my opinion, significant as downside levels to get reactions in. And everything between those two specific price points are going to be calibrated to a 5 or 0 level. With that said, I want to drop down into a daily, and you can see that we did go through this high. We traded through it, and we created a nice little run here, as mentioned earlier in the week, as I expected to see that. I did not want to see it run above this high and then go lower like a turtle soup, and I'm sticking to that narrative unless it proves otherwise. I just think that we have a strong likelihood that 96.35 level in here, that should find some support. It may need to come back down in here and clear up some of these equal lows, which we'll look at when we drop down into a lower time frame. But longer term, I'm still sticking with this up here because I don't want to go against a higher time frame long-term institutional order flow. I can be wrong in the sense that the market may turn in here. This could be a high, and it may be the top of the dollar index for 2019 entirely. I don't know that. I don't care to know that. I'm sticking to what the higher time frames are suggesting because that's what I trade with. So the times that I'm allowing for myself to be wrong and allow errors in my analysis to come in, I would rather err on the side of following higher time frame institutional order flow than to try to pick a top in bullish markets. I've done that in my last 20 some years. Many times earlier in the first third of my career, I got slapped around a lot trying to do that. So it's important that you understand that when I teach this, it comes with a great deal of pain. I know what it feels like to lose a lot of money trying to pick tops in bullish markets. It just simply is inconsistent, even in my own hands. So once in a while I might get lucky, but I'm like laser guided when I'm looking for highs in bear markets and lows in bull markets. So that's where I keep my attention. But we're looking for, like I said, the expectation going into this coming week is consolidation and or a little bit of bearishness. I'd like to see it resume higher. If the analysis I'm going to give relative to the euro, cable, and gold market are wrong, then we'll see a continuation, if you will, on the dollar index going higher. We're going to drop down into a 15-minute time frame. Okay, we're looking at the 15-minute time frame on the dollar index. There's a couple points I want to bring up. This was that clear trading range that I mentioned on Twitter that I did not like. It was too clean on both sides. But now that prices traded away from it, we left it intact. There's a lot of liquidity resting below these lows. Okay, so sell side liquidity I think is going to be the target next week. At least the first half of the week, I'd like to see it trade down there. The equal highs in here for buy side liquidity pool, that was rated and we've broken down. If we looked at this price structure here, I would rather see it trade just back up to this low, not so much this one or this one or this one. I think that I would like to see it just trade back to here. So if we run back up here, close in some inefficiency to this point, that would be sufficient enough for me. Just looking at price when it's got this many lows, I'm just going to go with the lowest one and allow my money management to allow for any of these also to be traded back up into. Okay, so that's how we form fit our setup and our money management together in one cohesive plan of action. So again, the lower is the one I would look for to get it trades back up a little bit, find some resistance there, and then distribution again to clear up some of these equal lows. That's what I'm looking for next week. So initially going into next week, we're looking for some softness on dollar and trading lower. I noticed that 96.35 level, which is not showing on the chart, but it's residing just below here. So it would be interesting to see that. Let me see if I can get this to basically show. It's going to be probably as close as I can get it. Like the area is perfect. So 96.35 is that level we were referring to on the weekly chart. So it can come down here, clear up some of this, and then hopefully resume on the upside. But it could just go down here also and just go sideways and chop and allow all the other markets I'm going to talk about tonight to do what may in fact be shown tonight as their draw on liquidity. All right, so moving on over to the euro dollar. Okay, so right away it looks like it's a mess. But to the uninitiated, that's exactly what they expect to find. Yeah, uncertainty, not knowing what they're looking for. So let's put a little bit of lipstick on this. All right, so we have a buy side liquidity pool right in here that I believe that may be the target for next week. Notice it's also diametrically opposed to what we mentioned moments ago relative to the dollar index. It's sell side liquidity pool. We have a buy side liquidity pool here for euro dollar. One of the kind of like touch on one shot, one kill a little bit tonight because I know I do a lot of day trading because it gives me a lot of framework and examples to teach you price delivery. The same things, okay, and you have to write this down in your book again because it needs to be repetitive. It needs to be monotonous and boring, okay? Trust me, if I tell you to look at the intraday price action, I'm not trying to convince you to be a day trader. I'm convincing you by my understanding of price action and by way of showing you prognostication many, many times over the course of a week. It gives us a lot of experience inside of one calendar year. So all of those traits are transferable going into a higher time frame. So if we look at a 15-minute time frame, everything that we're looking at relative to a 15-minute time frame is applicable to a 1-year chart, a quarterly chart, a 1-month chart, a weekly chart, a daily chart, 4-hour, and so on. Whatever chart interval you want to create with the data, it can be manipulated to whatever you want it to be. If you have a platform that allows all that, you can create whatever you want. You can create a 37-minute chart. Okay, it's price is price. If we know what we're looking for, imbalances, inefficiencies, liquidity pools, internal range, external range liquidity, as long as you know what institutional order flow is on a higher time frame, you'll know what to look for your specific setup. And we all could be doing something slightly different, trading the same market at opposing times, be in opposing trades, and still get it right, and still be profitable. And if that didn't bother you, you weren't paying attention. So that's how dynamic that price action studies are. And it's important for you to find your own niche in this, because if I force you into a mold, it's going to be very hard for you to grow accustomed to that. Because think about it. I taught optimal trade entry on baby pips for years. And I think it's a very simple pattern, but not everybody could get it. A lot of people did, but a lot of people didn't get it. So why is that? Because everyone has a unique perspective. And I'm giving you the tools on how to decipher price action and find a time window in the week and specific days when it's going to be useful for you to look for a specific setup relative to the institutional order flow. And you don't need to trade just like me. You don't need to trade like the hot shots that are in our website's forum. Those individuals are only sharing their experiences because they're excited, they feel good about what they've done, and they want to encourage. The worst thing you could do is try to emulate me or someone else. And it doesn't even have to be me as the mentor. If you follow someone else and you've learned some things from other people, try not to do every possible thing you see them do, because you don't know what's in their mind. You don't know what's the thresholds that they're really willing to sit through, even though they may have a stop loss that they're sharing with you. They may not really want to be in that trade if it goes 10 more pips against them, even though they may have a 40 or 50 pip stop loss on a swing trade idea. You don't know those internal dialogues. So, and you don't know what they're going to do. Are they going to stick to their plan? Are they not going to stick to their plan? Are they going to reverse? And all those things are going to happen on an internal basis. You can't try to duplicate someone else. It doesn't work that way. That's why it's important that you understand, as I'm teaching tonight, there's a dynamic to the weekly range that we look for. Even though I'm showing you daily liquidity pools, equal highs and equal lows on Twitter, I'm sharing that publicly. But you also know that that's not what the mentorship is. It's just one simple approach to doing some of the things I do as a trader. It's easy. That's the part I said that I can put on USA Today's front page, and largely everyone would ignore it. But it would take them out of their job if they applied it. It's amazing, but simplicity, apparently, it's not good enough. Okay, so we're looking at the weekly range here, and I want to kind of touch on some things. When we look at our bias on the week, or when I give you my bias, the best thing you can do when you sit down with our weekly commentaries and intra-week commentaries, you want to see, what am I drawing your attention to? What is that draw on liquidity? Because that's going to be the greatest influence most of the time. I'm going to be wrong. Don't get me confused here with my persona on Twitter. Here in the mentorship, I want you to understand that I'm going to get it wrong. And I'm eventually going to do it wrong on Twitter, and people will see it, and that's fine. There's nothing wrong with that. But I want you to know, learning how to do this and learning to be consistent, you're going to find there's going to be periods where you just have a dry spell. And I had that, Tuesday into Wednesday of this week. I wanted to sell short Eurodollar. It just didn't give me that setup. And I don't want to rehash that and make this video any longer than it already is going to be. But you've already heard that. So listen to the previous recording and you'll hear all my thoughts about that. But what I was looking for is that weekly liquidity pool. That's what's being highlighted here. So I'm drawing that red line here to draw your attention to it. So when we opened up on the week, I expected some measure of protraction or Judas swing on the upside. That's fine. We're expecting that. If it's going to be a down close week or an expansion to the downside, now what do I mean by that? And this is where you need to be writing your notes in. This is the weekly open, essentially right in here. The weekly open for me is 4 on Monday. I don't change for daylight savings time. This is my weekly open. That opening price, anything above that, I want to be a seller. Anything at that price, I want to be a seller. If it's just below it, it's a close proximity entry. That's still good enough for me. Why? Because if that's the opening price, and you know that as soon as we get to 400 on Monday. Now, when daylight savings time is in effect or when it's not in effect, again, I'm not shifting my time window. This should be at 500 and it's at 400 because I don't care to follow daylight savings time. Now, I don't tell you that in the free tutorials, and I don't want you to get on Twitter putting it on there trying to be smart. Okay, there's too many people just widely spreading this stuff, and you're just diluting it. You're just making it of lesser value to the community because you're all paying to be here, and I paid a great deal of pain and loss to learn all these things. So, like I said, it diminishes the whole thing. Believe me, no one's going to respect you, okay, for doing it. They'll love you for a minute, but once they get the information from you, they're going to cash you to the curb. So you're here, you paid for it, keep it to yourself. Be stingy with it. But the opening price at 400 on Mondays, that's the opening price for the weekly range. I don't care who else is teaching you weekly strategies, okay, and claiming that they've created something entirely new and it's innovative and they, you know who I'm talking about, okay. This is the real thing. This is what it is, okay. This is how IPTA delivers price over the weekly range. This is the delimiter, okay, where you start on 400 on Monday. That opening price, you want to draw that out all the way to what would be the end of the week. And put the daily dividers on. You'll see right there. That's what it looks like. Now, from that opening price, on Monday, Tuesday, and Wednesday, I am really, really stalking the open and anything above for a setup. I already explained to you in a previous video, I wanted this to go a little bit higher because had it done it, I would have had that weekly high. I would have nailed it. I already know I would have. But it didn't go high enough for me. And as it dropped down, I felt like it was going to slam it up there a little bit later in the day. It didn't do it. Okay, so in here, this is where smart money accumulates their short position. Now, why are they assuming short positions? Because the draw on liquidity is on that weekly chart down here. Watch the previous recording, last week's video, and you'll see what I'm talking about relative to what that weekly liquidity pool is. You want to have these levels on your chart. I don't share them on Twitter. And I don't mark them up to this degree because if I do that, you're not going to do the work and the homework and the study of marking the charts up and then seeing how price trades throughout the week, intraday, day by day, and at the end of the week. You see what I have been internalizing all week. Now, it's one thing for me to say this and say, well, yeah, you're putting it on the chart right now, Michael, because it works. No, go back and watch last week's video. I told you exactly where price was going to reach for. Granted, we want it to go lower. We want to see it trade lower into that weekly inefficiency for the euro dollar. But we have to take things on a modular basis. What's the next downside objective? We have to scale those out. And as they keep breaking, and a new one slides in the role of the next downside objective. This weekly objective for weekly liquidity pool, that's what we are looking for price to do. We want to see it trade down there. So now, right away, at 400 on Monday, that's the opening price, and this is the weekly range. This is what we're looking for. Now, how much of a deviation beyond that is unknown until we study the intraday standard deviations with central bank dealers range, flout, and or Asian range, and time of day and day of week, coupled with the weekly opening and the weekly draw and liquidity. The open to the weekly liquidity pool, that is our intended weekly range. So that gives us an idea how many pips are available. But since we're working with a liquidity pool, we know that the ideal characteristic is that we want to see it trade to that and then reach under it. But how far do we reach under it? That's what I was mapping out last week. I was giving you ideas for the cable market. When we talk about it, you'll see what I mean by that. But we're looking for the weekly draw on liquidity. And if you do this, it will give you one shot, one kill setups. But you have to incorporate everything, not just your little favorite little thing about ICT. Or maybe you're trying to ring in something else from another discipline and you're going to muddy the waters up and it's going to make it harder for you to learn. So I want you to think about when we're looking for bearish scenarios, okay, we're looking for opportunities for the market to expand on the downside relative to the weekly chart. That means all we're doing is looking for setups that's going to formulate a short strategy, and it doesn't mean we're holding to Friday's close. Why? Well, if you look at the weekly range here that's being depicted with the weekly power 3, I know it's light. I know the colors are light, and I know the colors are different now, but my eyes have been acting up lately, and these are very comfortable for my eyes. But the lightness over here is simply because I don't want to take too much attention away from what price is showing you. But from a very light silhouette, this is the depiction of the weekly range. We have the opening, the run higher. Notice this run higher didn't occur until late Tuesday and going into Wednesday. Notice that. It's very, very important. You want to see these things over a large sample size. If you do this with your charts every single week, you will get this and you'll understand what makes one shot, one kill so leisurely. It's a really lazy man's approach to being consistently profitable hunting the weekly range. Monday, Tuesday, or Wednesday, that's when it's going to form. Now, it sounds like a whole lot of time. Oh, when it could happen any time, Michael. No, it's going to happen during a kill zone. It's going to happen during one of them. I don't necessarily know which one it is. I just know 70% of the time, the weekly highs formed generally during the London session on Tuesday when it's really, really strongly bearish. We're in a consolidation still relative to the daily chart. Eurodollar is in a range. But because we're in a range, we have to think like IPTA is going to operate. It's going to use liquidity pools as support and resistance. Just think of what you've learned in those books that make you feel like you've learned something smart, but you can't make any money with none of that. If you take the idea of support and resistance and you apply it to buy-side liquidity pools, sell short above old highs, and then hold on to it and then wait for it to run below old lows, during consolidations, that's the protocol. It's very, very simple. It's hard to stick to it because sometimes you see very energetic price movements and then you think, well, we're in a trending movement. No. That's why it's important to do your analysis at the beginning of the week, during Saturday, Sunday. Have it in writing what you think that the weekly range is going to do. You're not trying to forecast the closing price on Friday. That's not what I'm trying to do. I don't promote that idea. All I'm saying is I expect this weekly range at the very minimum to trade down to that weekly liquidity pool. But what is it going to do when it gets there? It's going to seek the stops below it. Well, that's what we see here. It ran down below it here and it rallied back up. Then dropped one more time and look what it created. Double bottom. That's retail what? Support. Like I shared on Twitter today. Before it happened, we had equal lows. Well, price drops down on Friday to clear that up. Normally, this is for your notes again. If we have a bearish week, Thursday's New York Open generally will cap the week and create the low. If it's a bullish week, Generally, Thursday's New York Open will cap the week, and that'll be the high of the week. Okay? So, we talk more about this later in the mentorship, but I want to give you guys some meat, something to really chew on, because there are times where students come into the mentorship and they say, okay, well, he's just teaching day trading. I'm not a day trader. And they grow disenchanted, or they don't really know what I'm trying to teach them because it just feels like scalping. And I'm not teaching scalping. This whole concept here, okay, this whole thing of these double bottoms being ran out from a short up here to run that down here, all that is the same thing being applied to the daily chart. Because this red line here, that's that same liquidity pool on the daily chart that looks just like this. We have a double bottom, and we're expecting it to drop down to clear that out. Well, this is that same fractal. It's the same pattern, just being applied to a 15-minute time frame. Uh-oh. One of those aha moments just happened. You're learning, aren't you? So if we know that there's going to be a double bottom in the marketplace and it's Thursday, is Thursday going to create the low of the week? Probably not. Probably not. Now, notice I'm saying probably, because that's what we're working within. We're working in probabilities. We're not doing a 100% accuracy thing around here. I'm not trying to even remotely come close to that as a teacher to you. I'm not trying to preach that at all. I'm saying that if you follow these rules over a large sample size, you should see more accuracy than errors. But there's going to be a large degree of human error in there, especially in the beginning. I have students that just started, and you know who you are. I don't get this yet. You just started. Okay, you're not going to get it the first month. You're not going to figure it out the fifth month. The fifth month is when it really starts getting crazy because you have a whole lot of content. If you start with this and use this as a model every single week, when I'm telling you where I think the market's going to go relative to the higher time frame, because that's what I'm teaching you. I'm teaching you bias with a daily chart. I only talk to you in reviews with the lower time frames. Have you noticed that? Why? Why am I doing that? Because I'm teaching you the emphasis of higher time frame premise. If you don't know what that daily chart's going to do, you're going to lose. It's that simple. You're not going to know what the day trading bias is going to be. You're not going to know what the one shot, one kill bias is going to be. You're not going to know where the pitfalls and landmines are that we have to be aware of that's going to cause adversity in our trade idea, unless you understand that daily chart, and occasionally using the weekly chart, because that's going to give us a greater parent to subordinate theory relative to price action. And what do I mean by that? What we expect to see in the weekly chart is going to be overshadowing or overpowering or controlling what the daily 4-hour, 1 hour, and 15 and 5-minute charts are going to do. Looking at a fractal or an idea, or if we think we're bullish on a 5-minute chart, it has nothing to do with changing the direction of the marketplace, what is being shown on a weekly chart. There's going to be more emphasis or strength behind that weekly idea. So when I give you the weekly analysis, what I'm teaching you before the fact that I'm telling you where it's going consistently, every single week we see this, every single week. When I learned how to do this, I learned on the daily chart because I didn't have the ability, because I had a job just like you. I had to be out there working. So I had to learn, what is that daily chart telling me? And then when I was introduced to market making concepts, it quickly bridged the gap because I knew right away what I was missing. The things that we talk about on the daily chart, that is the gospel for the week. That's what we're sticking with. That's that plan A I talk about on Twitter. There's no plan B in our concepts. It's going to work or we're getting stopped out. Done. There's something to think about. Nothing to argue about. The trade didn't work out. You got stopped out. That was part of the plan. That was the plan. You're willing to take the trade, and you're willing to take that loss if it trades to that specific price point. Not, well, if this doesn't work, then I'm going to hurry up and get back in. Because what that does, it teaches overtrading, it teaches chasing price, and it's a neophyte's approach, period. All they're doing when they do things like that, and when students try to do that, they're trying to create a situation where they're always going to have an answer. You don't need that. Focus on the higher time frame. Look where the draw on liquidity is going to be, and then frame your ideas every single week based on what I'm showing you. When you do your demo trades and you work within that context, and why are you actually working with Aussie dollar? Why are you looking at Kiwi? Why are you looking at the British pound versus the Japanese yen? All you're doing is prolonging and deferring your understanding because you're distracting yourself with looking at other pairs. I'm only giving you two pairs, euro dollar and cable. And I'm teaching you a gold mine of insight because these markets are being heavily manipulated right now. So I'm teaching you, even in those environments, I'm able to find setups. The people that are new here, wait till we get into the trending market. You're going to think this is ridiculously insane how accurate, how powerful it is. This is where you're going to get all your money taken from you. But if you're not paying attention and studying only the euro dollar and the British pound versus the dollar, you're stunting your growth. So that's my soapbox for tonight in this week's review. And I really want you to listen to this video a couple times, not just once, because there's a lot of things going in it tonight that are going to help you bridge those gaps that you're having right now, keep you focused on what you're supposed to be looking at and studying each week, and help you formulate an action plan. Because I point to where it's going. Then what are you supposed to do then? What are you studying? Everything you learned in the current month's content. And only apply that. Those lessons will build on each new month's content. But if you apply what I'm showing you tonight, it will supercharge your growth and your understanding. Okay, so let's go back into it. We had the High of the Week form on Wednesday. Well, that's right out of the free tutorials, as you would expect. All right, so let's go back into the chart here. We're looking at the Wednesday high. It says it's high of the week. The market trades down. It reaches into that weekly liquidity pool. It does so here. Rallies away, trades one more time, creates a double bottom. Comes all the way back up to at least the equilibrium price point of the weekly high, from this high to the new low. Trades back up to midpoint of that. Why does it do that? IPTA does that to pick up more orders and allow fair value entries on the banks. The market trades down lower, comes back up, rebalances, and then drifts, and then makes an aggressive run down to make the low of the week. Here's our 10, 20, and 30 pip grade swings below that weekly liquidity pool. So everything here, if we zoom in, $10 pip right here, 20 pip right here, 30 pip here. Just fell short of it. It's like 29 pips or whatever it was. Didn't quite get down to 30. But it gives you a nice rule-based idea every time we look for a run on liquidity. So when we have these theories, okay, when we're looking for price action to do specific things relative to that daily time frame, we incorporate the daily time of day and the kill zones to formulate ideas when liquidity will be rated, okay, when the stop runs occur. All of the things that cause the market structure theories, like we have these double bottoms, which is what we call on the Twitter feed Candyland, they don't like to leave price action like that. So we're going to anticipate this whole run here. If we know that that same fractal that's being shown here works on a 15-minute time frame, and it works on a 1-minute chart, a 5-minute chart, why won't it work on a daily? Absolutely will work on a daily. In fact, it's going to work more often on the daily than it will on any other time frame. Why? Because the interbank is based on what that chart's showing. It's going to give you the truest form of knowing where the market's going to go, the most sensitive price points on the highs and the lows, where there's fair value, where there's inefficiencies, and where there's buy-side and sell-side liquidity. Everything you're looking for is derived from that daily chart, because you can still pick up the insights that would be seen on a weekly chart by studying a daily chart if you know what you're looking at. Now, don't read too much into that and say, send me emails or ask me on Twitter, what did you mean by that? You learn all that in the mentorship and beyond charter level. It's important for you to stick to one narrative. That means seeking liquidity outside of the candles. Now, what I just told you is what I hint at all the time on Twitter. But the uninitiated, they have no idea what I'm saying. I'm looking at what's outside of the candles. That's the liquidity. In this case here, it's the sell-side liquidity pool. There's nothing down here that's being seen in retail's mindset in terms of what they see on their chart. They see that as support. I don't. I see that as liquidity, and it's outside of the chart. Think about it. You look at, as a retail trader, support, resistance, trend lines, moving averages, indicators. They're all very interesting. They're entertaining, but they rarely work. I look at things that aren't necessarily seen in price. I show you where fair value gaps are. I show you where inefficiencies exist. Buy-side inefficiency, sell-side inefficiency, buy-side imbalance, sell-side imbalance. I show you and tell you what the narrative is that creates those things and why the market will reach back to it and what it should do once it gets there. All of that is outside of the understanding of a chart from a retail perspective. That's why you, as my students, are learning how to do what 99% of everyone else around the world cannot do. Predict price. We do it every single week based on what we do on that daily chart. That's the secret weapon for bias. If you do not use that daily chart, you're going to struggle with your bias. It's just as simple as that. So if we go back and we look at that idea of when the market is seeking that higher time frame draw on liquidity, which is again is that weekly liquidity pool, from Wednesday down to here, we're above that opening price. So all up in here, we're close to, if not at the very high of the week. Why would I say that? Well, we have equal highs in here. We have a high and a low, so there's a range in there. So if we just look for simple optimal trade entries, go back to baby pip days, low to high, we're basically at the sweet spot, creating the high of the week. So everything I was giving you on baby pips still works, but you need to know how to use those things I taught on baby pips. Once you understand mentorship level, you can go in there and pull out Trader's Trinity, things I don't talk about anymore, and you can literally look like a wizard to the retail world because you'll be able to do things with price action that no one else is able to do because they're looking at patterns for pattern's sake. They're looking at Elliott wave and trying to decipher what's the count, what wave are we on, what ratio should I have if I'm a ratio trader, what harmonic pattern is harmonic right now. Okay, it's look, anybody that's interested in harmony, okay, in what they're doing, use eHarmony, okay, and they're not a sponsor. That's the only harmony you need to have as an individual, okay, because if you try to incorporate harmony in price action, you're going to find that you are going to struggle. You're going to find that you're trying to force things, you're trying to look for things, okay, instead of saying, what is price most likely trying to do here? It's going after the money. Whose money? Large funds. It's just that simple. It's just that simple. That's why COT works. COT data, Commitment of Traders reports. What is that? It's showing you the relationship between the large pools of liquidity being held by the large funds. Who gave those positions? to them. The counterparty is the commercials, the large institutions, the banks, the producers or manufacturers of that market or commodity. Since the currencies are a commodity, we understand that the relationship for price delivery is not based on the retail universe. Retail is too small. It's too insignificant of an animal that doesn't leave a mark. It just can't, it doesn't support it. But large funds, large funds are the market. They are the buyers and sellers. The liquidity providers are the commercials. So we look for the relationships between those two parties in price action, and where their stop loss would be, that's where the market's going to go. Where a return to a level that would not necessarily be seen as bullish for a large fund trader, the commercials would see that retracement lower to fill in some fair value and then pick up more orders and then go higher and move against the intermediate term swing low and high that would be against the large fund's position. And you'll understand what that means later on in mentorship, because I'll teach you specifics on how to find it in price action, real accumulation, real distribution. And you can measure that with tools that I'll show you using price action. But when we look at the weekly analysis videos, it's important that you go with a specific plan. What are you supposed to do with the information I just told you on Mondays, usually, okay? And I'm trying to get in the habit of doing this on Friday, so that way I have the whole weekend to myself, and then Monday I'm doing what you all are doing, looking for setups, okay? I'm not worried about making a video, okay? So what do? If I'm bearish, okay, I want you to go through this protocol. Find out what the opening price is on 400 on Monday. Draw that all the way out to the line that would create the end of the week for Friday. And that's your opening price for the week. When I'm bearish, the ideal scenarios are going to be very, very close to that opening price. You want to sell short when you're bearish at the opening price or very close to it, and ideally above it. Because if you do that, you end up getting the weekly power 3. And you're entering just like the banks do, right up here in the high. Knowing that the higher time frame draw on liquidity is that weekly liquidity pool, that's the range, okay, from this opening and anything above it down to that. So that's your range. You're looking for setups between that. When will it form? Monday, Tuesday, or Wednesday. Now notice it's up here on Wednesday, trading above the opening price. And we hadn't really started to take off going lower yet until in here. That's why I gave up and said, okay, I'm done because I've missed it. I'm not going to be able to hit that one shot, one kill on euro dollar here. I just can't do it. So I need to wait for another day. What day is it going to be? Well, Thursday set up beautifully because I had a double bottom here. And I didn't believe, and you'll see over long periods of sample size, that if there's a double bottom midweek during a bearish week, Friday's going to be used to disrupt it. And this is typically what you see for a non-farm payroll. Okay, so if you see this on a non-farm payroll Friday, that's where you see me usually get right when I'm talking about the non-farm payroll release and where price is going to go. So I just taught you again something that you've seen me do before, but I've never really talked about it. This is how you decipher non-farm payroll. You want to look for the double bottoms that form in bearish weeks ahead of non-farm payroll, and then non-farm payroll release, that's where they'll run it. If it's a reverse, say this is like Thursday's price action, non-farm payroll Friday, when it's bullish, they'll send it up there to blow out their stops. So you're getting a huge amount of insight in this video. Tons of information. More information that you really need. But I'm showing you the depth of what you can do with this insight, because when I talk to you just a few minutes usually on the Monday videos, the weekly commentaries, I'm just basically telling you this is where I think it's going to go, and then let's all sit back and watch it happen. But I don't want you to sit back and say, well that was neat, he's right. You're practicing inside of that same time period. Everything you're learning on the individual monthly content lessons, the things I teach you inside of those daily recordings, because I put a lot of stuff in those recordings. The heart of the teachings are not just the 8 lessons at the top of the page each month. It's inside those discussions I'm having every single day. You're going to get more insight, just like you're getting it right now, because this is exactly what I did during those live sessions. I gave you things that you're not going to get in a PDF. You're not going to get it in a specific teaching video, because I already know what most of these goobers are doing. They're selling it, and they want to make it neat and clean. That way the people keep buying the next video. I don't want it neat and clean, because you've already subscribed to this as a long-term membership. Oh, now it makes sense. I didn't just come up with this idea in 2016 on a whim. I've had very, very lengthy experience with people taking my stuff and abusing it. So it takes work for you to get this. And it's intended for you to work for it, because I'm not giving you the sugar to get out there and throw it on the street and collect your $25 a month or whatever you goobers are trying to sell it for. So if we know that there's a draw on liquidity on the higher time frame, and when I say weekly liquidity pool, okay, it's being derived from the weekly analysis for the bias. That's not a weekly chart liquidity pool. Okay, so make sure you know that that's being discussed only in the respect that I tell you that's the weekly liquidity pool draw on liquidity. That's all. It's not a weekly chart. I guess you could still classify it technically as a weekly chart liquidity pool if you look at what we talked about last week relative to this level. But that's the range. Okay, this is your range, the opening down to that. So there's your dealing range. Okay, that's your weekly dealing range. Now, there's going to be deviations outside of that weekly range that create the opposing extremes, which is the low to close or the open to high. Now, if we're bearish, like I've been on Eurodollar, because I'm bullish dollar, we're expecting that opening price and some measure of protraction, okay, or Judas swing, basically. When it goes up, this whole run up is a suspect price move. It's fake. It's false. It's meant to get people excited. Look at the energy. Once we got back to the opening price of the week, a huge run in one single candle, it expands up. That's very, very enticing to a retail trader. And it's also frightening to someone that's short. They start thinking, man, I'm going to get stopped out. They collapse their trade, or they get their stop really taken. Then it consolidated, and then one more time they punched it up on Wednesday, and then off to the races it went. I didn't capture anything in here, as I mentioned. I would have loved to have been able to do that, but I know what I'm looking for. So when price rallied up in here, in that run, that's exactly what I was looking for. Back to equilibrium. What's the equilibrium? The low of the week so far to the high of the week. It goes right back up into the middle of that. It left equal lows. So what am I expecting? Friday run on liquidity. So I want to capture the market move when it's going against that run on liquidity down here. And because I expect it to go deeper on that weekly idea of that weekly expectation that we're going to go lower, the liquidity pool on those equal lows on the daily chart is this red line. So if I expect a run below that red line, if we do our grading of 30, 20, and 10 pips respectively, you can see that there's a great deal of symmetry to that and precision. Even though the market is, by all standards, looking at a daily chart on the Eurodollar, it's a mess. If you zoom in on it, it's just a big choppy mess. No one outside of our group knows what to do with it. They just, well, I don't know what to do with it. They're getting beaten up. They're trying to buy long on breakouts. They're trying to sell shorts on break below the old lows, and it's going right back to the middle of the range. You aren't learning how to do those things. You're learning how to operate in that type of market environment. That way, you won't be enticed to go outside of your pet market. Because if you have just one or two markets, you have everything you need. You do not need to be worrying about S&P 500. You don't need to be worrying about pound versus yen. You don't need to be worrying about what Bitcoin's doing. You don't need to be worrying about what the stock market's doing. None of those things will be an enticement to you because you know how to find money in the thing that you're studying. period. Now, there's going to be times once you learn how to do all these things where you can say, okay, well, this market's kind of slow right now. So I know I usually trade this market, but I'm going to come out of that one because there's a real hot opportunity in the bond market, okay, or the metals market. Knowing when to do that comes with experience. You have to learn all these boring things we're talking about tonight that are modular little pieces to the larger whole. But when you start to form a comprehensive approach to using all of it, clarity comes that I can't really articulate with words because it's an experience. Once you experience it, it's nothing. It's like nothing else because you know what you've been looking for all this time. Now you see it, and it's in the chart every single day, every single week, and that's why I'm able to do what you see me doing because I know what I'm looking for. Now, notice what I said there. I did not say I know with 100% assurity what the market's going to do. No, I didn't say that. I know what the market's probably going to do. But I absolutely know what I'm going to do when it tells me it's going to go lower or higher. I know what I'm waiting for. That's the paradigm shift that needs to take place from a retail trader's mindset is, the ascending triangle and the descending triangle and the pennant and the bull flag and the laser trend line gimmick of the month. Whatever it is that they use, all those things are going to have one-hit wonder status here and there. But you don't experience that when you look at the market from an institutional basis. Understanding institutional order flow starts by having what I'm teaching you here. Mapping out the entire week relative to what the daily charts liquidity pool is. Where's the draw on liquidity? That sets the tone right there. Okay, are we bullish or bearish? If we're bearish, we're going to be focused on Monday, Tuesday, and Wednesday for shorts. And if you blow it and you don't get the high or the low relative to the weekly bias, then you look for a smaller price swing or a smaller fractal with the same idea. Well, that's what's shown here on the Eurodollar and what you saw today on Twitter. If we apply this theory, we are not forecasting the close on Friday. Notice where the price closed on Friday. I don't care about where Friday's close is. I don't care about it. I want to know where's the likely expansion. What is that? That's the open to the low when I'm bearish, or the open to the high when I'm bullish. That's the range I'm working in. And that's all I care about because that's that pound of flesh, okay? That's that hunk of meat, okay? You as an apex predator are hunting every single week. Now, for the ladies, it's probably a little bit more gruesome than they want to hear in light of those that are not in favor of those types of analogies. That's the opportunity, okay, or the range of pips that you're looking to harvest inside that weekly range. For the men, because we're wired like cavemen, I teach from a predatory standpoint because that's what we think. Grab our club, go out there and club it over the head and drag it back to our cave. It's ours now. It resonates with men. It doesn't resonate with every man. It just resonates with most men. The sniper theory, same thing. I use all these gimmicks to get your attention to listen to what I'm telling you. If you listen to the heart of my messages, I'm telling you the real market. That's the underlying pinnings of the market. That's the real nuts and bolts. Not the terminology, the theory behind it. Okay, the theory is what's important. That's the narrative. If you understand the narrative, then you understand what price action is going to be. Then you understand what retail things you can use. Because once you understand the real narrative, you can take a retail toolbox, trend lines, basic chart patterns, bull flags, bear flags, all those stupid things you try to use with your own trading and you got stopped out and lost money on. You can do those things once you understand real price action. Once you understand this, then you can take anything and apply it to a chart and make it look like wizardry. So, again, I'm not concerned about where that closing price is. I'm worried about the open and how far I can go down. That's my range of opportunity. But the original dealing range is the open down to the weekly draw. whatever that is, okay? It may be an order block that it's trading down to. It may be an old high. Whatever I'm framing my trade on, okay? It's not limited to just using liquidity pools. That's the easiest one. And if you just use that one, guess what? You'll be a success at it because it's easy to do over and over and over again. But I just want to know where that expansion is likely to go to, because that's going to give me opportunities to scale out where's my draw on liquidity here. Okay, so if I know that that's a liquidity pool, they're going to want to sweep below it. How far below it? Well, start doing your grades, 30, 20, and 10. But if we approach a mid-figure or a big figure, there's a new protocol that has to come in place. Then you add another 10, 20, or 30 pips below the mid-figure or full figure. And then by doing that, you'll get very, very close to the actual high and lows of the week. Are you just hearing how to do weekly highs and lows? Welcome to the inner circle. All right, so going over to the cable. Here's cable again. Pretty erratic price action from the uninitiated perspective. But we're looking at, again, the same premise that we're looking for a lower run on liquidity. Okay, we had a liquidity pool mapped out on the daily chart last week. We were looking for the market to reach down below those old lows and tap into some of that sell side liquidity. All right, so here is cable. We can see that there is a very clean level in price action starting of the week. Okay, here's 400 on Monday. Draw that out in time. That's our opening price. Okay, if we know that that is our opening price, at that price or just below it in close proximity and ideally above it, that's your best shorting opportunities. Right away, you can see that we have equal highs here relative to this short-term high, then this high, and then this high here. Too clean. Price will not like to leave things like that in price action. We have this market protraction, shoots up, runs in, creates the high of the week, blowing out the buy stops. Go into your charts. I'm going to save some of this stuff for you to go and look at. But the main premise is what you see here. In my own personal journal, I have all of the details that I'm talking about verbally, but are not on the chart, because I know what you're going to do. You're just going to print my chart out and put it in your journal. And that's lazy, and you're not learning anything by doing that. Notice I'm not going to do this level of detail every single time. I do it once in a while to remind you what you're supposed to be doing. And since we had a large influx of new students come in for February, I'm giving you a framework on how to go in and practice everything I tell you what to expect in terms of the analysis. What are you looking for? How do you mark your charts up and study each day? And at the end of the week, what you're supposed to go back and look for. Because you're going to miss some things, okay? So the equal highs, we see that run here. And price breaks down, we create a breaker. Go back and watch last week's video, and you'll hear me give you exactly the one shot, one kill setup that took place here. Now, I'm going to frame all that out for you here. The market traded back up into the institutional 80 level. We're expecting a run back into this bearish breaker, and we said that we would see price run down below those lows on the daily chart. Again, that's what that weekly liquidity pool, that red line is. So from the open up here to that's your weekly dealing range. IPTA will work within that range. The standard deviations that we do internally from an intraday perspective, that means the central bank dealers range, the Asian range, and the flout, those will help you fine-tune the highs and the lows, respectively. But the weekly dealing range is defined when we're bearish. Okay, that's our bias. If we're bearish, we expect price to go lower. What does that mean? From the opening price on Monday at 400, that's our opening price, and we're bearish to what? The weekly liquidity pool. That's our dealing range relative to the weekly chart. There's going to be deviations above and below that. We want to be ideally in some movement above that opening price, because that's where the smart money accumulation is going to be on short positions. They're running stops on large funds. Where's the large funds having their stop loss? Well, when price went down here, the logical explanation for why the market would run up here from an institutional standpoint is because this is too clean. Large funds will want to put their stop loss here because they're trend following in nature. That's all they did. They ran up here and took those stops. They didn't see Joe Schmo over at FXCM in UK. This is where his stop is, so we're going to run the market there. That's not what's going on. It's going against the large liquidity pools on the funds. Large funds. I mean, people are trading huge. When we look at COT data, okay, where it says the large funds, not commercials, the large funds, that's what the market reaches for, that liquidity, not anything else. Not your stop, not my stop, their stop. That's what it's going for. Okay, that's what makes the market go everywhere. IPTA will work on previous swing highs and swing lows and internal range liquidity relative to what has happened in specific days looking back. And when you get to month number 5, you'll know what I mean by that, because we teach the market has a specific model that it uses over and over and over again. And once you learn it in month 5, your understanding goes through the roof. But looking at where we are in relationship to the days of the week, if we put the day dividers in, again, high of the week is formed on Wednesday. The market runs above an equal high liquidity pool, runs those stops, breaks down. Who cares if we don't get in up here? Who cares? Because we know that this run on stops is going to create what? If it's bearish, it's going to create a breaker. Okay, that's why you heard me say we're going to see the market run up in here, trade back up at this low, and we'll see it sell off down below those lows on the daily chart. And it does it that same day. Then it trades to a big figure. And I mentioned this in the commentary. Okay, on this day, the evening of this day is when I did the recording before this movement here. Go back and look at the file. In fact, you can download the file and you can see the date when it was formed. And if you have it on your PC, you can actually pull up the time when that file was created. So again, it's all there for your learning. I mentioned that if we trade down below that weekly liquidity pool, or the draw on liquidity, okay, relative to the daily chart, there's equal lows. Again, watch last week's video. Don't just watch this one. Watch last week's as well. I mentioned that if we go down to that 128 big figure, okay, that's the draw under those equal lows that we were reaching for. Then we have another protocol. We have to add another 30, 20, or 10 pips below the big figure. Once we do that, again, we get very, very close to the low of the week. If you start looking at your intraday standard deviations, you'll get the very low of the week to the pip. Not one fluctuation above, not one pipette off. It's exactly the low of the week. Same thing with the high. Now, again, the premise is we're looking for one good setup per week. Do we necessarily need the absolute high and the low of the week? No, we do not. All you need is 35 pips, 25 pips, 50 pips, as much as 75 pips as a best case scenario of that weekly range. Now watch what happens. From the opening down to the liquidity marker that we're looking for the draw on liquidity, we're just going to call that 28.35. Okay, I'm not sure what it is. 28.25. So 28.25, and the open we'll call 29.25. Okay, so it's 100 pips with no deviation above the open or below the draw on liquidity considered. Right away, it's 100 pips. Do you think that you could reasonably find 25 pips out of that? I'm believing that if you really study month 1 and use this lesson tonight, you will have the highest probability for a new student to find 25 to 30 pips in that weekly range. I'm a firm believer of that. Once you understand everything that I've shown you here, and I talked about the day before this unfolding, when price was here, I said we're going to trade up to this price point here, and it's going to sell off. And it's going to go down to the 128. Once it trades the 128, we expect it to expand another 30 pips, as much as another 30 pips lower. That's this line right here. Just gets a little bit short of it here, but that's the low of the week. Notice now, we have a bearish week And we had no equal lows over here to worry about. The market creates the low of the week during when? New York Open on Thursday. Bingo. Again, knowing what I said to you on this day for Thursday's trading, because the weekly draw on liquidity hadn't been traded to yet. So once you had that run down into it, then incorporate the big figure and adding the protocols of additional 10, 20, and 30 pips lower, that gives us how much it can be a standard deviation below our draw on liquidity. If that didn't hit you right between the eyes, listen to the last 10 minutes I just said again, because I just gave you a gold mine. I just handed over the keys to Solomon's mine to you, just as simple as that. You aren't going to appreciate it until you practice it and see it week after week after week after week. Months from now, you're going to be able to look back in your journal and listening to what we do on a weekly basis and quickly realize that you know what you are looking for. It's going to happen. Now, it doesn't mean you can effectively trade it. It just means that you know what you're looking for. Once you find that little hint of that thing that you've grown accustomed to seeing in price action, and it's going to be slightly different for everyone. And I know it doesn't sound right. Wait a minute. You should be telling me one specific recipe, and this is going to be it for everyone. No, that's not how it works. Now, I can give you what I've given you here. Equal highs and equal lows inside of a range, expand out and snag that outside of the range liquidity, or what we call here external range liquidity. Not all the time will it create a reversal once it takes the equal high or equal low out. Sometimes it just continues on. You'll learn that by understanding charter member stuff. But you have to know the foundational studies like this. Trust me, charter members are learning right now. Okay, don't think that they're not sitting there writing with their pen pad, writing down all this stuff, because believe me, they're soaking up knowledge tonight just as much as you are. I'm like a fire hose. Okay, it's hard to drink from because I have so much inside of me that I want to give. But I can't give it all because of time. Look how long this video is already. I had to stop and come back to it because I want to remind myself constantly that there's a great gap between what you already know from free tutorials and what I want to take you. And I also know that I don't want to give you too much because you will want to trade before you're ready, because you may see it 1 or 2 times, 3 times, and then right away, I got it licked. I'm done. I'm not even going to worry about next month's mentorship. Not that I care, because if you don't want to be here, don't be here. But I don't want you thinking that you figured it all out and you're going to trade with live money. That's not what I want you to do, because you will not fully appreciate it until you see a full calendar year of sample size data, because you will see the seasonal tendencies influence, quarterly shift influences, all those things. Which reminds me, March 8th, if I'm correct, I think that's when the CFTC said that the commitment of traders data will be in sync. So we're waiting for that to do our quarterly analysis. So I know we didn't get one at the first of the year, but we had a lot of issues going on with the federal government here, and I like to have COT data. I was going to do it without it, but I said it would be inconsistent with what I've taught, so I'm forcing myself to stay out until we have the COT data, and that's supposed to be March 8th. So there you go. But we have the market reach all the way back up into mid-range equilibrium, leaving a great deal of uncertainty for cable. Now, because there's really no clear draw or equal highs in here for cable, here's another $1 million tip. We have something very clear for euro. Nice equal highs. For the dollar index, we have these equal lows. So think about what I've shown you here. Price action is really clear for this potentially to be ran out on dollar. So we're bearish dollar. Okay, there's a given. Going into next week, initially we're bearish dollar. Roll that into euro dollar. Well, we have bullishness for the buy-side liquidity pool. We'll probably see it pop up into there. Okay. Do we see these same signatures in cable? No. So what does that mean? When I see situations like this, this tells me that euro dollar is going to be stronger and cable will probably be held in a range. So what does that mean? Euro pound is probably going to be bullish next week. Euro pound will probably see some expansion on the upside when we see situations like this. Okay. If I'm wrong, it won't make a difference because the stop losses, if I take a trade, will do its job. I'm not worried about a plan B. Okay. I'm not worried about that. My bias becomes questionable, or it needs to potentially be revisited for another change once the euro dollar clears the buy stops here and the dollar index clears the sell stops here. But until that happens, I'm sticking with plan A. There's no plan B. Okay, so I'm waiting for that to happen. If we rally, never even get down here, then I'm wrong. It's simple as that. There's no, well, let me find an excuse to justify. No, you're wrong. Your stop's going to do its job. You suffered a loss. You were wrong. Learn from it. Next trade, please. That's how you do it. That's trading. That's the real world. So going back to cable, the one shot, one kill is this setup here. 50 pips, range from here down to here, plus do all of the run to the big figure. Then if we hit the big figure, expand down 30 pips. Okay, that's here. We just fell short of it. But again, use your standard deviations for central bank dealers range, flout, and the Asian range on this day here. You get the actual high and the low. And you actually end up getting the low of the week and in the high of the week over here on Wednesday. Now, by taking all those things and blending them together, and again, not trying to forecast the closing price on the weekly range, because again, that's what this yellow drawing is. I'm drawing out what a open, high, low, and close candle or bar, not a candle, would look like on a weekly basis. So when we internalize price action every day, yes, we look at it on an individual intraday basis. But the way I internalize price is this is what I have in mind. The whole time I'm watching all these gyrations, the opening price is what I'm aware of the whole time. You do not see me tweeting my charts with this on here. You don't see me tweeting the buy side liquidity pool with the opening price, and I'm not, because I'm basically giving it away if I do that. You're here because you're paying to be here. So this is what I see internally in my mind. So when we have the opening price, all of the price action here, we're right in here. Where's it likely to go? That red line, that's the weekly draw on liquidity. So when price is trading here, where's it still going to go? To that red line and below it. Why? Because that's what the higher time frame daily charts suggest it may do. So I'm siding on the probabilities that this is where the market's going to most likely go. I can't stress enough the importance of knowing the draw on liquidity. That's why I gave it away in the scalping series. That's a free tutorial series. Those 3 videos are absolute gold mines because I'm giving you and everyone else that watches it a very, very simple approach to knowing where the market's going to go and how to operate in it. Now, there's so much more to learn and to refine that model, but it's a very, very good foundation because it teaches you real market efficiency, how the markets trade, what the market efficiency paradigm, what you as a retail trader thought was going on, and what the real narrative is. That's that market efficiency paradigm. Everything that you think is going on in the marketplace is 180 degrees opposite to that. You think it's this, when in reality it's that. Okay? And it's the truth. It really is the truth. So if you see all the things that we talk about, it seems like a lot of moving parts and seems like a lot of random hodgepodge, unorganized, fragmented teachings. How's this going to come together? Believe me, I designed it this way because you need to know them individually. But when you practice each week, you're going to see these types of things unfold. Every single week, things like this repeat. Think about this. Why did Thursday's New York Open create the low of the week here? Because there was nothing else for it to run to. It ran its weekly liquidity pool and had no double bottoms to reach to go lower, unlike Eurodollar. See that? Double bottom, rated, back to the middle. Cable, no double bottom, New York Open, done for the week. Now, knowing that, it will keep you from looking at this high to this low. Oh, here's an optimal trade entry going short. It filled a void. No, it didn't. No, because anyone that went short doing something like that, they got crushed. And they're probably feeling, if you've done that, you're probably thinking, wow, he just explained what I did wrong. Now you understand what was wrong with that idea. Because when we map out our weekly theory, we're not looking for 500 pips, okay? We're looking at the nearest realistic draw on liquidity. Now, once it trades there, we have to reevaluate it based on time of the day and what day of the week it is. Because IPTA works on that basis. Day of the week, time of the week, time of day. Period. Simple as that. Okay? Now, it doesn't feel simple to you. But when you watch this video 2 years from now, you're going to be like, I know exactly what he's saying now. I didn't understand it so much when I listened to it the first time, and I can see it when ICT points it out and draws it on the chart, but I just can't see it right now. You know what? That's normal. There's nothing broken inside of you. You're not stupid. You're not slow in learning. It's not too complicated. It's something new that's technical, and you need to have time. You need to submit to the time aspect of this because I cannot tell you how long it's going to take for you to get it. It took me 6 years with no one helping me to figure out my first pattern, and that's what I gave away in the scalping series. That was my first profitable understanding, and it still works today. Gravy train. From that model, I learned everything else. When not to use that model, when to fade it, the things that happen in between that model's framework create scalps. If you apply all those things to a weekly chart, you have a long-term position trading strategy. What? Yeah, how about that? Because price is fractal. So I don't personally like the long-term trade, but if you do, these components and concepts, all these things work the same way there. You don't need to worry about kill zones. You don't need to worry about any of that stuff. It helps because it helps you frame a really, really low risk entry with a higher time frame. You can end up with like 101 R multiples on trades, because if you use a day trader or scalper's entry strategy on a move that you expect to trade over months, the R multiples are ridiculous. It's insane. Okay, it's ridiculous. That's why it's important to learn scalping, because you can really, really break down the risk. You're always going to have risk, but you can reduce the risk down to such a degree where it just it's unimaginable. Let's just say it that way, because if you literally look at a move that took place on several months on a monthly chart, go back and break those the beginning of those movements down on a basis like I'm showing you here, and you'll quickly see how you could have done that many times with less than 20 pips as a stop loss and capture 1,500 pips, things like that. I'm not saying you're going to make 1,500 pips. I'm saying that those are types of examples you can do. You know, what's 20 pips risk to make 1,500 pips? You know, that's a huge R multiple. So risk-reward models are insane when you do those types of trades. I don't have the patience to hold on to those, and I like to have velocity. So that means I'm going to see a lot of setups that I can pick and choose from inside of that weekly range and the idea that I have on the weekly range. And I can compound my money greater than someone that sits in a long-term position trade. Now, I'm not stating that if you like long-term position trading that you should be coerced out of that thought process to do short-term or day trading, because it can have more velocity and I can compound faster. So therefore that makes it better. No, it's not. What is the better method or model is the one that suits you and you're not comfortable doing anything else. That's the right one. The one that you're comfortable doing and uncomfortable not doing. That's your model. Clearly, you see me excelling at what I do best, which is one shot, one kill, and day trading. I know it like the back of my hand. I don't care what market it is. If it's moving, I'll be able to do just what you see here. That skill set creates a great deal of confidence. That confidence, if you don't rein it in, will become overconfidence and an arrogance, okay? And I still suffer from it. So I allow myself to not be arrogant in my trading because I have a Twitter account. And I allow myself to play online. And I say whatever I want to say out there. I don't worry about who it's going to offend because it's my outlet. And then in here, you see how I am. This is how I am when I'm trading. I absolutely am all business. I don't want to be monkeying around with anything. I'm not goofing off. I know what I'm looking for. I'm waiting for it. When it enters my crosshairs, it's dead. On Twitter, you don't know what you're going to get. But the things I tell you about the marketplace are true. My mannerisms and the way I act on Twitter is just a character. That's me being relaxed about everything that I do, and I'm trying to get a rise out of other people. And it may not be the rise that you think I should be getting, and I incite a lot of drama because it's entertaining for me, but it also allows me to release the ego side of my trading and keep it out of the mentorship and keep it out of my personal trading, because ego and arrogance will make you think that you're better than you really are. And believe me, I know where my limitations are. I know that I'm blessed by God. I didn't deserve this level of success apart from his providence. And if that offends you, deal with it, because I am a firm believer that that's where it came from. You may feel that you've learned it from me, but I'm telling you, you're getting it from him. And I'm just a conduit. So if you submit to the long-term process that I'm laying out, you will get this, folks. You will get it. But you cannot get it in the first couple months. And you're not going to get it your first pass through the full 12 months content. You're going to have to go back and revisit some of these things, because there's a lot of content. There's a lot of things you're going to learn about yourself, and things that you want to do right now, you're going to learn later on that it's not possible for you to do what you thought. And you have to do a different approach. It doesn't mean throw everything out the window. It just means that you need to restructure your plan about how you're going to engage the marketplace for your career. All right, so in quick summary, we've mentioned on Twitter, and I think I did a recording, but I talked about the S&P. I told everyone to denote their charts for these equal highs. We have a sell side imbalance, buy side inefficiency, and we have the triple top. So we're making fast work of getting back up into there. A lot of retail traders were trying to capture a top here. Wrong. But this buy side liquidity pool, I still think that's the one we're going to reach into. And we have this low that closes the inefficiency up. And then notice we have the double top up here. So we could run through here, pick up some orders, and continue on the higher path to get that higher high. That's personally what I think is going to happen, but we still have to figure out what we're going to do once we trade here, because it could come up there and then come back rather wickedly, and then longer term, come back here later on in the year, or just make a straight run for it, and that would be really impressive. Last bit of business for Forex, we mentioned that we had a buy side liquidity pool resting remaining in here. We saw that hit here on Thursday beautifully, traded back down, optimal trade entry, and made a run back inside this buy side imbalance, sell side inefficiency. We'll probably see a little bit more of that, and then we'll see if we want to target the liquidity resting below this low next week, because we have that bearish dollar. And in the final discussion, this is gold. All right, so gold, I mentioned on Twitter that we were looking for this run above these equal highs. Now, think about what I mentioned on the dollar index. I said that dollar could go sideways, it could fail to rally, and it could fail to go lower. If it picks up steam going lower, this is going to cause the dollar bearishness to roll right into bullishness for gold. Right now, this is our equilibrium of our original consolidation here. So expect some sensitivity around that 113.35 level. If we run through 113.35, it's going to be a clear shot right for these equal highs up here. What I have here is this is the market maker buy model, and I have all it laid out, and you can see all the turning points, and you learn this in the mentorship. So if you haven't figured all this stuff out yet and haven't gotten to that month where we talk about it, trust me, everything, even at the charter level, will be built upon. So anything that a charter member thinks they know about market maker buy and sell models, they don't know it all yet. And trust me, it gets insane. But the curve is the lowest point at which the market created the low and then turned. Anything to the left, okay, that's what we refer to for our PD arrays, and you learn about that in month 5. Everything to the right is where you actually have to use for your entry patterns. The weekly chart shown here, if we drop down into a daily, a lot more refinement, and you can see all the turning points here are beautifully illustrated with relative points of reference on the left side of the curve. Really nice movement here. We want to see energetic movement past the equilibrium. If it hits this and starts to sell off, that could be the end, and this could be left in the marketplace for months. It doesn't have to be quickly taken out. It only will be taken out quickly if we run through the equilibrium with energy. Then we know that it's going to continuously plow into this. If we hit this level and start to pull off, that makes these highs suspect for a little bit of a time. We don't know how long it's going to be then. So the defining moment, what makes me know when a market's going to run through old highs or old lows, I find the consolidation ahead of it, break it in half, and that's equilibrium. And if IPTA has a struggling point getting through that and spends time around there, I get really uncomfortable with the whole idea of this quickly being taken out. And not that I want to turn around and have a plan B going short. It just means that my original plan A is probably going to be met with near-term resistance, and I have to think about another market to trade, and then I'll wait for something else to further develop with gold. But beautiful illustration. I know Maine has been long on gold relative to what he shared on Twitter. I don't know if you still have it, but it certainly looks good from here going up into those 1370s. So nice run. About $5,000 worth of profit, close to it in terms of unrealized gain still. But this is the market maker buy model, and this is what you see. Really, really refined. It's not Wyckoff. Okay, it looks like Wyckoff. It has a lot of similar characteristics because that's how I found it in price. Because I saw Wyckoff stuff initially. It made sense because I saw the patterns over and over and over again, but I don't like to jump the creek, break the ice, all that nonsense, even though I have silly names like Judas swings and breakers and mitigation blocks and all that stuff. It's limited in scope. And I'll just tell you that. If you don't believe me, study Wyckoff, okay, and then come back to what I teach with the market maker buy and sell model. It is completely light years ahead. It blows it completely out of the water because it's precise, whereas it's vague in concept, where it's enough to make money if you know what you're looking for, trading Wyckoff stuff. But when you incorporate the institutional order flow aspects of what I do, it turns Wyckoff into a juggernaut. And I've always been up front and told everyone that Wyckoff was the foundation of my market maker buy and sell models, but it is not what is being shown. And everyone that's ever studied Wyckoff, is in the mentorship, knows right away that yes, I was influenced by it, but I put it on steroids, and nobody can argue against that. You just can't look at something and say, oh yeah, that's the markup phase and the markdown phase of Wyckoff, and that's all it is. No. Study what I'm showing you, because I'm giving you the actual turning points inside of the overall markup and markdown phase. No one else is doing that. So, it's to the pip too. So nonetheless, we have a full basket of things to watch this week. We had a lot of things we talked about in this recording. This video is chock full of huge amounts of insight. I took a sampling from just about every month's content and gave you like little samples of things. All of those things that I gave in this video all are foundational to a model. You can create a dozen different price action models based on this one recording tonight. You don't feel that you know that much because you just heard it one time, but I gave you so much insight in this one recording. What I just gave you, if someone were to ask me, can you come and give a keynote speech on trading? This is what I would talk about. I would use these charts and I would say what I just said tonight. Simple as that. Only people that are versed in technical analysis would appreciate what I said because they've messed around with price action for enough time to know that everything else is falling short of what we're learning here. So if it didn't feel that impactful, chalk it up to you just simply not being versed enough in technical analysis or studying charts long enough. Everyone that has studied price action to any degree and with any other style, what I've shown tonight is going to feel like a missing link. It's going to feel like I just bridged a huge gap. It brought you a huge bit of insight. It brought you closer to your goal as far as understanding what price action should be doing right now and how to trade and engage with it. The unlearned, the new students to trading, many of you are going to be by way of crypto. Your first exposure has been through the crypto markets. And that's not true market delivery. That's mania. So if you feel a little detached still, it's because you just don't have enough chart time. And maybe some of you are saying, wow, this is really technical, but I can see what he's saying. Could I find it on my own? Probably not. And guess what? Let me repeat that. It's normal for you to feel that way. It's absolutely normal for you to feel that way because you're learning. You didn't learn how to ride a bike the first time you got on it. You fell off of it. You didn't learn how to drive a car the first time you turned the ignition. You bumped the curb. You hit the bumper on something. You hit the cone when you were practicing. All those things are normal. Don't put too much emphasis on being perfect right now because I'm not perfect and I authored these things. So relax, allow yourself to develop, and I'll talk to you again midweek around Wednesday with another update. Until then, I wish you good luck and good trading.